Many may and fairly claim that it's too early to call this a sustained or sustainable pullback. And I understand why. It hasn't been very deep on the surface of things in the major indices. But we also know that it's not fun to be too late to a sustained pullback. So we want to avoid pullbacks if we can. And I think there's a number of reasons why we should not think that this pullback that we're starting to see in the markets and maybe in its very early stages is over. I think there's plenty of reasons for that. Let's take a look at where we are. We are, really making an approach for all-time highs. Some of the largest stocks are there. Microsoft has been there in the past few days. Apple's been there in the past few days. Nvidia is obviously well above that. And that last one, I was talking to some people about this last night. Nvidia and Tesla combined aren't as big of a market cap as Petrobras. Or their earnings last year combined, Nvidia and Tesla, aren't as large as Petrobras's earnings were last year. That stock trades at 2 times earnings, paid roughly a 50% dividend last year. And neither Tesla nor Nvidia are in the top 50 most earnings companies in the world. Yet, they're both in the Magnificent Seven, which have had such tremendous gains so far this year. Now, I'm not trying to say a company, or, all companies should be in line in terms of market cap order, the same that they are in terms of earnings order. That's not necessarily true. Companies have different growth rates, and we pay a premium for better growth rates, and we don't for lower growth rates or decelerating growth rates. But while there may be a few exceptions to the rule, it seems as though earnings growth is not only not present, but is actually decelerating. That's what we saw in the last quarter, despite positive GDP. GDP was positive, and typically you would assume that's associated with earnings growth, but it's not. It's not associated with earnings growth in the most recent quarter. And given the leading economic indicators we're getting, the full effects of the Fed tightening yet to be felt, higher interest rates, tighter capital at banks, and we know potentially increasing capital requirements at banks, reserve requirements. That is a unappreciated Fed tightening tool, but it is actually, in fact, both a financial stability and Fed tightening tool. It's reasonable to assume that GDP might slow from its current levels. And we know this because even Bostic, who is apparently the largest dove, he is the only one who has said that he doesn't want to do another hike. We previously thought Goolsbee was the biggest dove, but he hasn't said as much. What he has said is that CPI doesn't give him much confidence. What Bostic said, in addition to saying he doesn't want another hike, is that if the economy doesn't slow, then he would support additional hikes. He also said, even if the Fed doesn't tighten, if inflation falls, holding at this level, and he said he wants to hold for most of next year, so quite a while here we're talking, that just holding will continue to add pressure onto the economy, not only because of lag effects. He didn't talk about lag effects when he was making this point. He talked about the continued increase in real interest rates. So even the guy who doesn't want to do another hike wants a continued increase in real interest rates and continued tightening and pressure on the economy. So, the person who doesn't want an additional hike wants and needs, in order for that to be the case, additional pressure on the economy. So, given we are already experiencing an earnings decline with good GDP, given that we need inflation to fall, given that we need demand to fall, it's reasonable to assume that earnings should at the very least not be growing, but more likely than not, sorry, just water right here from my bottle, more likely than not, actually declining. So the current S&P 500 earnings multiples we are at, I believe, have only been seen, I heard this, have only been seen during the COVID bubble and the dot-com bubble. Don't think we're in that environment anymore. That was an environment with low interest rates, hardcore stimulus, very expensive valuations, people questioning the dollar, looking for alternative currencies, and we are now in a very different environment with Fed tightening. The people who control the money are tightening the money supply. They're tightening the cost for money. They're trying to put pressure on the economy, not stimulating to grow the economy at a tremendous rate. Yet, a lot of stocks are at all-time highs, and a lot of others are trying to get there, and they're trading very expensive and valued very expensively, in my opinion. The bulls have been trying to say, soft landing. We've kind of addressed at least my opinion on that soft landing idea. I'm not going to really try to debate it right now, but that's my analysis of it. The market clearly is perpetually optimistic. But even in January, Kashkari was saying that Wall Street and the Fed were essentially in a game of chicken, and Wall Street was going to lose that game of chicken. That was in January. The market has obviously continued to fight the Fed since then, in terms of not only the stock market performance, but also interest rate expectations. And it has continued to be wrong. So I think it's only a matter of time before the Fed wins the game of chicken. And will it be a surprise hike? I don't know. We just got 2 surprise hikes. Most banks apparently still, basically all banks except 1 or 2, apparently still aren't expecting the Fed to do what it says it's going to do. Fed Watch has increased from an 8% probability at the start of this week that the Fed was going to be at the end of the year where they said they were going to be. Last I checked, 16%, but that was yesterday. Yields have fallen. So that leads me to the conclusion of this video, which is I do think there's additional ammo for a sustained pullback. Obviously, the earnings picture is going to take some time to play out. Months and quarters we're talking. But also, interest rates, once we kind of get through some of this data, stabilize, let things settle out, should probably be higher. The 2-year should probably be above 5%. That's where it should be. If we're above 5% in the Fed funds rate, they're going more in the Fed funds rate, and they're not going to cut for most of next year. And even beyond that, interest rates are still going to be relatively high. We talked about it before. Before, in like a couple months ago, we were saying the 2-year needed to be at least 4.5%. We've been hovering a little above that now, and now we're moving that from 4.5 to 5%. So let's see if it happens. That's our projection. That's what we think needs to happen. But we'll see what happens. So that's today's video, and until next time, peace out.